Hey folks, CB3 here with your monthly market update for May. It was a good month overall, although not all stocks in the market participated as well as others. We'll get into that in detail. Stick with us. The May monthly market update starts now. What a month May turned out to be. After the craziness of April due to the Liberation Day on April 2nd, and after a rocky start to the year, Wall Street delivered its strongest month in a year and a half. The S&P posted its best May since 1990, a gain of more than 6%. The Dow was up 4%, and the Nasdaq up 10%. And yet many people did not participate in this for reasons I'll get into later in this program. But nonetheless, it's still very positive for the market that May looks like the bottom is in for this correction. At one point, the S&P was down 21% intraday, although it never closed technically in a bear market. But we have seen that become history now. In my opinion, Nvidia was the standout for the month, jumping 23% in May. Nvidia is a strong tech stock, and many people value it as the most important stock in the world. Despite some mid-month volatility, and thanks to this renewed tariff headline noise and a brief flare-up in U.S.-China trade tensions, the market just kept shrugging off the noise, and that's good for us as investors. A pivotal early May trade deal between the U.S. and the U.K. raised hopes that further trade relief is in sight. Even as President Trump's administration announced plans to tighten technology restrictions on China, I think you're going to see other countries in Europe come to the table. Worth noting though, May was blockbuster. The S&P is basically flat for the year as opposed to down. So make no mistake about it, May has put the market back on a solid track and restored investor confidence. What's driving it? Tech leadership. I just mentioned Nvidia and other tech stocks. Tariff relief hopes. The market participants are seeing that this tariff war is gradually smoothing out and may come to an end, especially if Xi Jinping is losing control as the premier of China. Expect to see him out of office by the end of the summer. Solid earnings are coming in as we finish the first quarter earnings report, and we'll be starting the earnings reports in just a month for the second quarter. And resilient consumer spending. That is always key, folks. As you know from my broadcasts, 2/3 of the U.S. economy is driven by the U.S. consumer. And the consumer continues to spend. So looking ahead to June, we're probably not going to be able to duplicate that performance that we had in May this month. The S&P has averaged a return of about 0.6% in June over the past 5 decades, with gains 2/3 of the time. So that means 2 out of 3 years, May is higher, and that's good. Seasonality suggests we might be entering a digestive period, but again, I think that's more tariff influence than seasonality at this point. So what we're watching this month, tariffs and trade policy, economic data, valuations. The S&P is still trading at a forward PE of around 21, so expectations are high that earnings reports are going to continue to come in strong. And obviously, tech momentum has to continue because so much of the market relies on these huge trillion-dollar tech companies to pull the S&P along. Bottom line, we're staying invested and we're staying focused. The market's message is clear. Don't get shaken out. Now, we did take stops in many stocks, so I wanted to address why some money managers are not outperforming the S&P. I'm one of them. Many money managers that I know have struggled during these last 2 months as they have protective stops in place to protect against a big downside vicious move, which is not happening now because the tariff brouhaha blew over. Well, we didn't know that when this was all happening. And so our job is to protect our clients' portfolios no matter what. So this most recent data indicates that a significant majority of active portfolio managers failed to keep pace with the market. I don't know how you did. But if you're listening to this and you did well, you probably stayed in the market through the whole time, and that worked well for you. There are programs out there, and we trade one of them, that stays in the market all the time, no matter what. There are other programs that we have that manage risk more carefully for exact situations like this that could have been COVID, that could have been 2008, 2009. We'll have more of this. If you're a client, you're going to get our performance review year to date, and that'll be issued sometime early this week. The recent data from S&P Dow Jones Indices SPIVA scorecard and industry reports indicate that about 65 to 79% of money managers are underperforming the index this year. Again, if you're willing to stay in during these volatile times and have the tenacity to realize that one of these days this could drop to a 45 to 50% pullback, just like 2008, 2009, or even a 34% pullback like we had during COVID, you should stay fully invested. But again, many money managers that are actively managing for risk don't want to see that big a downturn. So this is one of those confounding times in U.S. market history. It happened in COVID when everything came back, and it looks like here now the market is in pretty good shape to continue an upward move. Looking ahead, I think the opportunities for June are strong and even better through the rest of the year, especially if some big trade deals get done with major countries like France, like Canada, like Mexico, certainly even China, but there are others that could participate. Switzerland with their drug deals, bringing pharmaceuticals here with manufacturing to happen on U.S. shores. Those are big, big news items, and the market will be buoyed by that, and you might see days that just go straight up when some of these trade deals are announced, and that's why we are staying fully invested in this environment. Hope that helps, guys. That's the story from May. Looking forward to June now. Be sure to watch my live show the second Thursday night. That's June 12th. We will see you then. Thanks for listening.